Hi, Ebal2708. This is the first of a few videos that I'll be making that looks at some of the work we'll be dealing with in terms of Unit 5, Natural Persons, Individuals. So you should, if you look at the news and what is happening in our economy, you should at this point be very aware of the fact that as South Africans we don't really have that much of a savings culture, and that has a direct impact on our economy, specifically once it comes to retirement age. And none of us really want to think about retirement and getting older and all of that, but the reality is we all age and we are all going to get to a point where you need to stop working. And the question is, what then? Because if you don't make provision for your retirement, you are either going to have to look at the state government to look after you in terms of an old age pension, etc., which if you have any family members that receive that pension, you know that it is barely enough to survive. And I mean, then you are just surviving, barely. Or alternatively, you are going to have to look to your children or grandchildren to look after you. I know that there is quite a bit of research that's being done on a concept known as black tax. Maybe you know about that, but that is also a reality in South Africa that, working people or productive young people have to, spend their money looking after their elders. And that, of course, is not a situation that is ideal, either looking at government to look after you when you retire or, looking at your kids or grandkids to do it. So we have measures from a normal tax perspective that sort of encourages taxpayers to make contributions to retirement funds, and how this is incentivized from a tax perspective is by allowing people to claim a normal tax deduction. Now, what is quite important before you start looking at how to do this particular section and how the deduction works is to go to your Student's Approach to Natural Persons, page 151, and have a look at the framework. Right now, at this point in time, this framework should be part of your daily life from a tax perspective. You should know that we start off with gross income, and that we then deduct from that exempt income, which gives us income as defined. Then we have deductions, and then we have taxable income before our capital gain. To that, we will add our taxable capital gain, and you know how to calculate the taxable capital gain at this point. And what I want you to see is that, over there, don't know if it's very clear, and over there, and over there, we have subtotals. Okay, so once you have determined all your transactions that affect your taxable income prior to capital gains tax, prior to your retirement fund contributions, prior to your Section 18A donation, you are going to calculate a subtotal, right? And this you'll pick up the more home tax questions you do. Once you've calculated your taxable capital gain, you're going to include it into your taxable income, and then you're going to calculate another subtotal. So let's call that subtotal A, and that one will be subtotal B. Now, ladies and gentlemen, this particular order here at the bottom is very important, because your last deduction in your framework will always be Section 18A. That is, you are not allowed to deduct it anywhere else. It has to be the last deduction in the calculation of your taxable income. Before that one will be Section 11F, and this is the deduction we're going to be looking at right now. And before then, so your third last item on your framework will always be a taxable capital gain. So when you do your calculation, now remember the principles are important. You don't have to stick to this format 100% as long as you apply the principles correctly. What you need to stick to in terms of format, though, are these last few deductions, because they have to be last in your calculation. So I will deal with everything. I will deal with salaries, I will deal with exemptions, including them in gross income and giving the exemption. I will deal with deductions if this natural person is allowed to claim the deduction, and then I will do my capital gains tax inclusion, do my retirement fund deduction in terms of 11F, and then only my donations. So this particular section, and this section number you must please know, is known as section 11 capital F, and this one changed a few years ago, about 2-3 years ago. SARS or Treasury amended it quite drastically to allow for bigger deductions in terms of contributions to retirement funds. So if you look at this little picture, there's usually a retirement fund in the middle, and we usually, from a natural person's perspective, have two people that can make contributions, or two persons that can make contributions to that retirement fund: an employee as well as the employer. So let's look at the employer first. If an employer contributes retirement funds benefits on behalf of an employee, right, the employee will be taxed on that as a fringe benefit. So that contribution that the employer makes, it will be taxed, included in gross income in the hands of the employee. And then the employer can claim deductions or contributions to retirement funds in terms of a specific or special deduction, section 11L. From the employee's perspective, and remember, this is the calculation that we're busy with now. We are looking at the natural person's calculation. They can make their own contributions in addition to what the employer contributes. That is going to depend on what your employment contract states. And then, in terms of section 11F, we are going to take the employee's own contributions as well as the employer contributions that he was taxed on as a fringe benefit, and we are going to determine whether or not he can claim a deduction. So section 11F starts off with retirement fund contributions. In other words, what are retirement fund contributions? And essentially it works out, any retirement fund contributions that you make during the current year of assessment, and this retirement funds for purposes of this section includes provident funds, pension funds, and retirement annuity funds, right? And these contributions not only consists of the actual contributions made by the employee, but it also includes any fringe benefits that the employee is taxed on. In other words, any contributions made by the employer on behalf of the employee that we included in gross income by virtue of the fringe benefits paragraph I provision. So we start off with the current year's retirement contributions, and to that we will add any unclaimed balance of retirement fund contributions. Ladies and gentlemen, essentially what this is, and I'll show you on the next slide, it's anything that you weren't allowed to deduct in a previous year of assessment, you can carry over and deduct it or bring it into your calculation for that specific year of assessment. So what is this unclaimed balance? Now you will see that I have crossed out a few things here because in EBAL 2708 we don't do the second schedule and we also don't do section 10C. So what is the unclaimed balance? It's any excess contributions, in other words, anything that's not deductible in the current year of assessment that is carried forward to a succeeding year of assessment and is deemed to be contributions made in that year, and therefore we may consider it in that specific year. So to do the calculation, we will look at our current year of assessment. So for our purposes, that will be 2019. And then we will also ask, but listen, in the previous year of assessment, so in 2018, it doesn't, draw so well there, but were there any amounts that I had contributed that I was not allowed as a deduction? Because that we can then also bring into our calculation. So what does this calculation look like? And my dear students, this is something you have to study, right? In other words, you have to know this format. All these amounts mean something and will mean marks, because that's the only thing that motivates you. Please tell me it's not. It's the learning that motivates you. But if you are only motivated by marks, then these amounts and these steps are very important. So how we will look at this is we will say, listen, what was my actual contributions? So, how much did I pay out of my own pocket and how much did my employer contribute on my behalf? We're going to get the total of the actual, and that is limited to the lesser of the following three amounts. The first amount, 350,000 Rand. There's no calculation into that, 350,000 Rand. Or, and if you look at number 2, there you have to be careful, 27.5% of the greater of remuneration. And please make sure that you have a look at your student's approach to natural persons 5.3.1 that sets out exactly what is remuneration. It's essentially anything paid by an employer to an employee. So the greater of remuneration or taxable income including CGT, and this is where your framework is really important. So, what is the subtotal of your taxable income after you've included your taxable capital gain, but before your Section 11F, this particular deduction, and your Section 18A deduction? Get whichever one is the highest and multiply that by 27.5%. Thirdly, take your taxable income before your Section 11F deduction as well as your Section 18A deduction, excluding any taxable capital gain. In other words, what was the subtotal of your taxable income before any capital gains, before Section 11F, before Section 18A? Choose the lesser of the three, and that amount limited to your actual contributions is then what you will be allowed to claim as a deduction. Any of your actual contributions that exceed whatever amount you calculated over here is excess and can be carried forward to the next year of assessment. Right, so let's have a look at an example together, but it's really important that you do all home tax questions to make sure that you practice this particular deduction. So we've got Harry. He earns a salary of 442,000 and a non-pensionable bonus of 5,000. He's a member of his employer's pension fund. So ta-da, there's our retirement fund. He contributes 35,000 Rand per annum in respect of current contributions and 2,000 Rand per annum in respect of past period contributions. Ladies and gentlemen, it doesn't matter whether it's current contributions or if it's contributions that the person is making because they want to sort of buy extra retirement benefits. If you join a retirement fund late, you can sort of buy additional benefits by making additional contributions. Doesn't matter. They all fall within the current year of assessment's contributions. His employer did not contribute to the fund. Now, what this tells me is that there will be no fringe benefit, which means when we get to the Section 11F calculation, I don't have to bring the employer's contribution into my calculation. His remuneration amounts to 447,000 Rand and his taxable income before this deduction, which is 11F, is 600,000 Rand. His wife is a teacher. She earns a salary of 235,000 a year and makes an annual contribution of 15,000 to the government pension fund. Again, doesn't matter whether it's a monthly contribution that they make or a yearly contribution, annual contribution that they make. It's a contribution to a retirement fund. Her employer also contributes 15,000 Rand per annum. So there we have to keep in mind that, listen, there is a fringe benefit and there will be a deemed contribution that we will take into account, and this has been included in her taxable income as a fringe benefit. Her remuneration amounts to 250,000 Rand and her taxable income before this deduction is also 250,000 Rand. Let's have a look at the solution and how much they can deduct in terms of their pension fund contributions. So we start off, and this is really the recommended work method, and I can also really recommend this. You start off with your actual contributions. So Harry contributed 35,000 Rand plus 2,000 Rand, so 37,000 Rand in total. And we want to determine whether that 37,000 Rand can be deducted or how much of that 37,000 can be deducted. Have a look at how they answer this, because all of this needs to be in your suggested solution or your answer that you give in the exam. It's limited to the lesser of 350,000 Rand or 27.5% of the higher of remuneration, which was given to us, and taxable income, which was given to us. So which one is the higher? It's the 600,000 Rand. So 27.5% multiplied by 600 gives me 165,000, or taxable income before CGT, before 11F and Section 18A, 600,000 Rand. So of these three, 350, 165 and 600, which one is the lesser? That, of course, is the 165. But remember, SARS will never give you more than what you actually contributed. So Harry actually contributed 37,000 Rand. So he will only be allowed to deduct 37,000 Rand. For Hilda, we also do the same. We start with what was her actual contributions. She has her own contributions of 15,000 Rand and then the 15,000 Rand that was contributed by an employer, which she is going to be taxed on as a fringe benefit. So she's got a 30,000 Rand contribution in total. Again, have a look at how this is structured. The deduction is limited to the lesser of 350. 27.5% of the higher of remuneration or taxable income, which in this case is exactly the same. So we can just use that amount, 27.5% or 250. So which one is the lesser? It's the 68,750, but we are limited to our actual contributions, which means she will only be able to claim 30,000 Rand. This is all about practice. Okay, so you have to summarize this. Make sure you put in all these steps, actual contributions. Remember, if there was anything in the current year of assessment that we were not allowed to deduct, we can take it forward to the next year of assessment. Make sure that you follow the structure and do as many home tax questions as you can.